start with $1 of sales. That means a customer paid the company $1. Now make 100 of them. Here are two companies. The left company has $100 of sales. The right company also has $100 of sales, same sales, but the stock market values the left company at $100, and it values the right company at $1,000. So the left company is priced at 1x sales. The right company is priced at 10x sales. Pause here. Which one looks cheaper? Most beginners pick 1x sales. That answer feels obvious, but it is not enough. Because the real question is not only how much sales does the company have? The real question is what happens to each sales dollar after it enters the business? PS only sees the dollar at the entrance. It does not show what survives. PS means price to sales. You may also hear sales called revenue. For this video, sales and revenue mean the same thing. They both mean money customers paid the company. Now look at the two objects. On top, the market puts a price on the company. Underneath, customers create sales. PS asks, how many dollars of company value are investors paying for $1 of sales? For the whole company, PS equals market value divided by sales. Market value means the stock market's price for the whole company. The finance word is market cap. But the plain English idea is, what is the market saying this whole company is worth? Here's the clean example. If the market values a company at $500 million and the company has $100 million of sales in a year, then PS is 5. 500 divided by 100 equals 5. So read PS 5 like this. Investors are paying $5 of company value for $1 of sales. Not $1 of profit, $1 of sales. And it is not a 5-year payback clock. Sales still has bills attached to it. Shareholders do not receive the whole sales dollar. That difference is the whole video. Quick recap. PS does not ask, how much profit did the company make? It asks, how much are investors paying for the sales coming in? You can also zoom into one share. Imagine the company has 10 shares. The company has $100 of sales. If those sales are spread across 10 shares, each share has $10 of sales behind it. That is called sales per share. Now imagine one share trades for $50. $50 of share price divided by $10 of sales per share equals PS of 5. Same idea, different zoom level. Whole company, market value divided by sales. One share, share price divided by sales per share. Just keep the units matched, company with company, share with share. Now send the same $1 sale through two businesses. On the left, the company sells a low margin product. A customer pays $1, but the company has to buy the product, package it, ship it, handle returns, and keep inventory. Most of the dollar disappears just to deliver the sale. Maybe only 3 cents are left. On the right, the company sells a software tool. A customer also pays $1. The company still has costs, but serving one more customer may cost much less. Maybe 70 cents are left before the rest of the company expenses. Same $1 of sales, very different result. Now the opening choice changes. The 1x sales company may be cheap for a reason. Its sales dollar barely survives, and the 10x sales company may still be expensive. But now you can see why investors might pay more for $1 of those sales. This is the main lesson. PS prices the sales dollar. It does not grade the sales dollar. So why use PS if it ignores so much? Because sometimes profit is not there yet. A young company may be spending heavily to grow. It may have customers, it may have sales, but after all expenses, it may still lose money. When profit is negative, PE can become useless. You might see N P Alps gives investors an earlier clue. It says like, there are sales here. What is the market paying for them? But do not confuse an early clue with a final answer. PS does not prove the business is good. It only tells you the price of the sales base. The next question is, can those sales ever turn into profit? Here is the first trap. A company has $100 of sales. The market values it at $800. That is PS of 8. Next year, sales double to $200. If the market value stays at $800, PS falls to 4. The year after that, sales double again to $400. Now PS falls to 2. On a finance website, this can look great. Sales are rising, PS is falling. The stock looks cheaper, but now reveal the losses. To get $100 of sales, the company lost $20. To get $200 of sales, it lost $90. To get $400 of sales, it lost $240. Sales went up, PS went down, but the business got worse. It was buying sales with bigger and bigger losses. Uncle Glide, warning, revenue growth is not a scoreboard, it is raw material. The question is whether bigger sales create a stronger business. Quick recap, falling PS can be good, but only if the sales are becoming healthier. If sales grow and losses grow even faster, the low PS may be a warning, not a bargain. Here is the second trap. A company is valued at $300. Last year it had $300 of sales. That looks like PS of 1. Very cheap. But what if last year was not normal? Maybe demand was temporarily high. Maybe customers ordered early. Maybe prices were unusually strong. Now sales fall from $300 to $100. The market value is still $300. The stock price did not move, but PS jumps from 1 to 3. Why? Because the denominator got smaller, the sales base underneath the price fell, so low PS can be real or it can be peak sales math. Beginner rule, low. PS only matters if the sales are normal and repeatable. Now make the comparison harder. 4 companies all trade at PS of 3. Each has $100 of sales. Each is valued at $300. Same number, different business. Company 1 has weak sales. Most of each dollar leaks out. Company 2 has stronger sales. More of each dollar survives. Company 3 has repeat customers. The same customer may come back next year. Company 4 grows sales but keeps creating more shares to fund the losses. More shares means each old share owns a smaller claim. That is dilution. The company can get bigger while your piece gets smaller. So, PS is not a verdict. It is a starting point. It says, here is the price of sales. Then you still have to ask, what kind of sales? This is why you should not compare every PS number across every industry. A grocery-style business may trade at a low PS because each sales dollar has very little room to become profit. A software-style business may trade at a higher PS because each extra sales dollar can leave more behind. An early-stage growth company may trade even higher because investors are betting on future sales and future profit. That does not mean high PS is good, and it does not mean low PS is bad. It means the number has to be compared to the type of business. The better beginner question is this PS high or low for this kind of sales dollar? When you see PS on a finance website, slow down around 3 things. First, is it using past sales or future estimated sales? Past sales already happened. Future sales are a forecast. Second, is the number really sales? Companies may talk about orders, bookings, billings, or total transaction volume. Those can matter, but they are not always the same as sales. Third, is the share count changing? If a company keeps creating more shares, sales can rise while your claim on those sales shrinks. That does not mean every company with new shares is bad. It means the PS number is not the whole picture. Simple number. Hidden assumptions. Here is the beginner test. When you see a PS ratio, ask 4 questions. 1, are these real sales? 2, are these sales repeatable? 3, does much of each sales dollar survive costs? 4, is my share of those sales staying stable? If you cannot answer those questions, the PS ratio is not useless. It is unfinished. It is the beginning of the investigation, not the end. Here's the whole lesson. PS tells you how much investors are paying for $1 of sales. It does not tell you whether that sales dollar is valuable. A low PS is only interesting if the sales are real, repeatable, and able to turn into profit. A high PS is only reasonable if future sales and future profit can support the price. So do not ask only, is the PS low? ask, how much of each sales dollar can become real profit for shareholders? Sales are the beginning of the story. Profit decides how the story ends. Educational only, not financial advice. Next in GoGlides Finance School, PB ratio, where the market price is what a company owns after what it owes.